All right, welcome back, everyone. Um, Welcome to episode two. Today, we're going to talk a little bit about how does price move. All right, so the first question we want to ask ourselves is what tells price what to do? In other words, how does price arrive on our charts, and how does it know what number to price at? So that's a great question. Let's take a look at a very high level general scope of more or less how things work. This will help you understand a little bit about the logic that will be used going forward. So I want to take your attention to this flow chart here. First of all, starting on the left-hand side, we have market participants. Who are market participants? Those are all the people who have money or positions in the market. So those would be people like you and me who are trading, or maybe people or institutions like banks, hedge funds, and everything else in between. Whether you're trading $5 or $5 billion on the market, you are considered a market participant. Now, in except for Forex, most other markets have a central exchange, and this makes things a lot easier, and at least for explanations. So, assuming that the market you're working in does have a central exchange, the way it works is that if I'm a market participant and I want to participate in the market, I have to enter an order. This order could be a sell order or a buy order, and there's different types of those orders, but that's not what I want to focus on today. What I want to focus on is that, you can either buy or sell in the market, straightforward, simple enough. And when I have an order entered into the market, that order has to go through an exchange in order to be executed and, you know, either bought or sold in the marketplace. So what the central exchange does is it processes your order, and that order is used by Price's algorithm. Now, I know things are going to start looking scary now because I just said algorithm and all that stuff, and oh no, are we talking about AI or and all that stuff? I promise it's not that bad. Don't worry. Um, what you have to know is that price functions off an algorithm. What that means is that it's not that price is reacting off, every order that comes in, it moves a certain amount, or maybe it does, but the important part to know is that the market is programmed, or price is programmed to move based on what the algorithm tells it to do. And how does the algorithm know what to tell it to do? Well, that's what we'll look on in a little bit. But the most important part to know is that basically market participants enter orders through an exchange. Order data is received or input into a price algorithm, um, however price is being priced in that way. And that's what ends up shooting out your market price. That's what you see on the charts. So the most important part to remember here is that price's algorithm is what's displaying the price that we're looking at on the charts. So let's dive a little deeper into what the algorithm does. Um, in the most basic sense, the algorithm, what it shows us is price. It's simply offering price. And the market participants, you, me, hedge funds, banks, institutions, trading firms, can decide to act upon the offered price. So we're all looking at the same price. It's not like banks and institutions are looking at a different price than we are. The same pricing is available for all. So what's the algorithm doing in its price offering situation? Well, it's looking for willing buyers and sellers. And it's not only looking for willing buyers and sellers, but it's looking for it in the most efficient way possible. So what are we going to call this? We're going to call this liquidity search. So for now, we have established that the algorithm offers price, and the way it offers price is by looking for liquidity. It looks for the places where liquidity is most likely to be held. Why does it do this? Well, this ensures maximum trading activity. Why is maximum trading activity important? Well, more trading equals more money in the market, which is either more money won or more money lost. But essentially, more trading activity is better total because there's more transactions, there's more volume, there's more interest in the market that's being per trade, and more liquidity often attracts more buyers and sellers into the market. So before we move forward, I want to define two things, and we'll go into detail later on. But I just want you to remember these two terms. We're going to call these upside pricing mode and downside pricing mode. From different education sources that I've used and have helped me learn price action, they use different terms for this. So in the spirit of not copywriting them, not taking their terms because their terms are theirs, I simply have worded something that makes sense to me and hopefully will make sense to you as well that while you're learning this. So just remember we have upside pricing mode and we have a downside pricing mode. These are the two modes in which price searches for liquidity. All right, so now we've established that the algorithm's purpose is to offer price, and it does so by searching for liquidity and hopefully finding it. We can ask ourselves, well, how does the algorithm in itself know where to look, or how does it search for liquidity? Well, I want to bring forward a certain stigma or a certain status quo that exists among trading strategies, whether that be price action or candlestick charts or regression lines or whatever type of strategy you look at. When you place or when you trade those types of strategies, you have orders placed above highs and below lows. Those orders can be stop loss orders, which will get you out of a bad trade, or they can be stop limit orders where we'll get you into a sort of breakout trade. There's so many types of trading strategies, but a lot of them are, I would say almost all of them, have orders placed above highs and below lows. So the algorithm uses this fact that exists among the trading community to know where to look for liquidity pools. What are liquidity pools? Those are just areas where high liquidity is expected to be. That's where the algorithm thinks or believes there are going to be orders. And most of the time it's right, and you'll see later on exactly how that works. But for now, just keep in mind that above highs and below lows, there are most likely going to be orders there. And so the algorithm is simply attracted to these places. It wants to go to these places because that's where it's going to find its next liquidity. So when it's going for liquidity, either price is going to be searching for liquidity on the upside. We're going to call this upside pricing mode. It's going to be searching for highs. It's going to be going to the next high and the next high and the next high looking for liquidity. And this is determined, or this is exemplified through price action that can be seen through higher highs and higher lows. This is what we looked at last episode, and I will repeat that when we start looking at the charts in a minute. And the next part is downside pricing mode, which is the complete opposite, the inverse. It's exactly the same, but just the inverse, where the algorithm, instead of looking for highs for liquidity, it's looking for lows. And the algorithm does this on all different scales, weekly, monthly, weekly, daily, 4-hour, 1 hour, all the way down to the 1 minute or even 10-second chart if you have that. The algorithm is constantly looking for liquidity on the specific scale that it's operating at. So we'll go a little bit into scale today, but I'm going to save scale for another video because it can be a tricky topic, as I had mentioned before. So let's go for it and see what that sort of upside downside pricing mode can look like. Okay, so now we have a look at the real charts. If you were just coming from my first video, you'll see that this is the exact same chart as we looked at the beginning, when we were talking about highs and lows and higher lows and lower highs and lower lows and all that stuff. But I've replaced the highs and lows with lines because they will be important in our analysis as we move forward. So I want you to take a look at a couple things. Let's start from this left-hand side. We have this high. There's a horizontal line going through, but we have a high being created. We have a low. Now this high is taken out and it comes back down to an area that takes price back up again. Now notice where it comes back to. It comes back to the same area that this high was, basically, to the tick, to the point, comes right back to the exact same price. It does not always happen like that. Don't expect it to. Sometimes it does, sometimes it doesn't, but I would never ever create a trading strategy around that because it just doesn't happen that way. But it is important to know that price comes up, and before coming back up again, it does come back down to that area that was just broken. And you can see this candle was really that decision to break it up. And it comes back down, and you can see the origin of the move here, comes right back down there, and it shoots back up again, creating another higher high. Now, before it creates this high, what does it do? It comes right back down again. Where does it come back down to? To the origin of this move up. And then it shoots right back up, down again. Sorry, right back up again, and creates this final higher high that marks the end of the move. How do we know it's the end of the move, or when do we know it's the end of the move? Well, there's a couple ways to know, but the most obvious and the way I want you folks to start learning about it or start seeing it in your own charts is to look for this low to be broken. Because why? Notice how this low is not broken, this low is not broken, this low is not broken on price's way up. But now when price starts to break down, this low is broken. And if price was not going to be going lower, if we expected price to go higher, what would the situation look like? Well, we would have this higher high being made, just as that's been done over here on the left-hand side. We'd have this higher high being made. We'd have price come down, and then we would expect price to go up and create another higher high just to continue this pattern that's being created. But it doesn't. What does it do? It comes up and creates a lower high. In fact, it doesn't even break these smaller scale highs that are being created in here. It comes up, creates a lower high, and shoots energetically through this low and this low. What does that mean? Well, this pattern, also known as upside pricing mode, that was being respected throughout this entire time, is no longer being respected. And we see evidence of that here. This is our first evidence that this upside pricing mode is no longer going to work. Second piece of evidence, once it breaks this low. Third piece of evidence, once it breaks this low. Fourth piece of evidence, well, price comes right back up, interesting enough, to the area that was just broken, and it shoots right back down again. Fifth piece of evidence. And now we have the opposite pattern being created. We have highs, lows, higher lows being generated over here. And as price breaks down, we have lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Now notice how price is going for these lows. It's simply, these lows are our method of locating ourselves within the chart. These are going to tell us where price is attracted to, where price wants to go. So for instance, if we are in an upside pricing mode, we can look for highs. We want these highs to be broken, these highs to be broken. Once price is no longer in an upside pricing mode, it's going to tell you by starting to break lows. So as the lows of the upside pricing mode are being broken down and respected basically in the opposite way that it came up, then you start to see that price is in a downside pricing mode. You can expect price to shoot, once this lower high is created, and let's say for some reason we were told by the trading gods or the market gods that said this is the end of price, where can we expect it to go? Well, we want it to shoot through this low, and then we want it to shoot through this low. So price breaks this low, breaks this one too, comes right back down here. What's the next low that price wants to break? This one that's missing right here. Breaks it nicely over here, comes right back up, Is there another low that price wants to break? There's this one, and there's even this one here. Here at the end of price hasn't broken it yet, but you can see how it's magnetic to it. You know, this big red candle comes to it, barely almost touches it before starting its move, starting to move to the upside here. I don't exactly remember what happened. I think it did come down here, but the most important part I want you guys to see is that this upside and downside pricing modes are essentially mirror reflections of themselves, and they often interact around the same areas. You can see how these lines, and if you extended this line forward, you would see that price is reacting in similar places, in places it has reacted to in the past. See where the time's coming in, where I told you before in the first episode where the variables we look at are price and time. Price is coming up to levels that have been respected in the past, and those levels are important because those are price's bearing points. It's where price looks for, because it knows those areas are important because they caused highs and they caused lows. So price comes to revisit them due to price's algorithm. All right, so this chart here is just a continuation of what I was talking about before. You know, these arrows right here are just showing, or at least training your eye to look for how price breaks a high and then comes right back down, just to look for where it comes down to before it makes the next high. That's what I want you guys to start focusing on, is not only is price in an upside pricing mode or a downside pricing mode, but really become aware of where price returns to before continuing its specific mode. So if it's an upside pricing mode, you want to see where it comes down to before moving back up and breaking the next high. You want to see where it comes back down to before breaking back up and moving the next high. Now, I want to bring your attention to this area right over here, where the dotted lines are. You'll start to see what we call a lower scale downside pricing mode. Why is this a lower scale downside pricing mode, and how can I tell? Well, first of all, we know it's a downside pricing mode because what do we have? We have a low, we have a high, we have a lower low, we have a lower high, we have a lower low, and we have a lower high. Exactly the same pattern that's happening in this entire scale, where we have a lower high, lower low, lower high, lower low, lower high, lower low. But what makes this a lower scale? Well, it's happening in between the areas that are important to us. So if we're looking for this low to get broken and to create the lower low that we would identify as, oh, okay, price doesn't want to be in an upside pricing mode anymore, it wants to go downside. Anything that happens in between that before it gets to that low, all the price movement is a lower scale, which means that it's not necessarily affected, or this doesn't necessarily affect what's going on in the bigger scale. The larger scale is the rules lower scale. The lower scale is just how price is moving into its larger scale moves. So I'm sorry that sounds a bit confusing, but I want you to start training your eye to see that. We're going to go into scale later in the videos. It's a bit of a tricky topic, and I'm going to do my best to clear it up for you, because it really is an eye-opening topic once you start to understand how scale works and how it can be used in the perspective of market reading, how it can be an incredible tool for you to use in your favor and to your advantage. But just want you to note that between this high and between this low, this area that we were looking to be broken, we have smaller scale highs and lows being broken without this low still being broken. So that's how we know it's a lower scale downward pricing mode. And these arrows here, again, are just for you to start training your eye to look for these highs and lows as price is in its current mode. Alrighty, so we've arrived at the time of homework. Similarly to how you did your last homework, I want you to go into the charts on TradingView, and I want you to look for a time in the past where price is in an upside pricing mode and where price is in a downside pricing mode. I want you to know why it's in an upside pricing mode and what's in a downside pricing mode. Remember, upside pricing mode is higher highs and higher lows, while downside pricing mode is lower highs and lower lows. And you should be able to start seeing them pretty clearly with a little bit of practice. Now, within each upside or downside pricing mode, I want you to mark the highs and lows with horizontal lines, just as we did in the previous slide. You can rewind the video to see, to take a look at that, and I'll show an example later on. But I want you to analyze how price reacts when it comes back to those highs and lows that were just broken, just those areas. I don't necessarily care that it's exactly at the precise point that it was just broken, but when price returns to the area that was just broken and marked with your horizontal line, I want you to see what happens as price is continuing its mode. So what does an example of that look like? Let's take a look. All right, so here's another example. This one is just an upside pricing mode. I want to show you that I chose this because, first of all, it's upside pricing mode. It's pretty clear to me, but it's not as obvious. There's lots of noise in here. There's something going on in here. It really is takes a little bit of practice to start, really seeing this high, low, higher low pattern start forming. In fact, you could consider this one as well being a higher high and a higher low as well. But you see these clear upside pricing mode happening. And as price goes up, which is the easiest part to see, you can start to analyze highs and lows being broken. So we have this high broken, comes right back down to the area that decided to break it, shoots right back up, creates another higher high, comes right back down, doesn't come back to the line. I didn't say it would work like that. I said it comes back down to the area, and don't worry about seeing exactly where it is or why it broke at a certain place, or why it decided to turn here and not turn exactly at the line, or why is it always not in the same place. That part you'll start to figure out in a little bit. Hopefully, with a little bit of my teaching, you'll be able to see it even clearer. But I just want you to notice that there's a pattern, there's symmetry here. Price comes up, returns to the area, comes up, returns to the area, comes up, returns to the area, comes up, and now I have a question mark here. Why do I have a question mark? Well, you see how price comes down and it doesn't really return to this area. It doesn't really get all the way back in there before creating this new higher high. That's telling. What does it mean? Well, we'll see that later on what exactly that means. But what I want you to do, and if you are able to spot in your upside or downside pricing mode, I want you to analyze, make a rectangle between this high and the line that you created, sorry, this low and the line that you made of the just previously broken one. You see there's this little gap in between this high and this low. I want you to see what happens when price gets back there. Imagine if price, started here and then it trickled back down and gets back down into this area between this line and this low, where price didn't return to. I didn't exactly go in and show you what happened because I don't want you to expect something. I don't want you to have expectations and say, oh, now when price comes right here, let's say for instance, it came back here and shot right back up. And you're going to start thinking, all right, so every time price goes into a little gap, an area like this, it's just going to come right back down and shoot back up in the direction it was. That is not true. It can happen, but it also just as commonly cannot happen. But the area is important. And I just want you to start analyzing these areas, what we call gaps, And I just want you to analyze what happens when price gets back here. If you find an example on your chart that you're able to see, evidently when a high is broken in upside pricing mode and it comes down and doesn't really come back down to the area that was just broken, try to see what happens later in time. Follow price and see what happens when it gets back there. And just take note of what happens. We'll talk about it in the next few episodes. We'll go further into detail and what that actually means. But I just want you to see for yourself. Go into it, do some analysis, do some studying, get creative with it, and go back to this video if you need tips or shoot me a comment, shoot me a message. I'll be happy to help you out if I have the bandwidth. I'm sure I'll get to it, and I'm going to do my best to help you. And we've made it to the end of the video. So I'm glad you guys stuck with me through this here. It's not easy at the beginning. A lot of these terms can be quite obscure, and when you're going through the charts, sometimes you might be watching the video and be like, oh yeah, that's pretty clear, it's pretty obvious, and then you go into the charts and you're like, what the hell, all confused, and nothing's jumping out at you. Do not worry, don't be afraid. That's how I started. That's how everyone started when they're learning price action. And it simply is a matter of going into the charts and marking them and seeing them and just really studying the charts as price happened. Just see how did price behave when it's going up, and how does price behave when it starts going down. And little by little, you'll start understanding where these places are, what they look like, and then they'll just become much more evident to you, and they'll start jumping out at you, which is ultimately the most important part of price action. Once you're able to identify areas of importance and identify what price is doing, then you'll be prepared to take your price reading to the next level, where you could potentially make decisions upon that, or of the sorts. Again, not going into trading with this, but just want to give a little bit of a forecast for you guys that are looking into trading in the future. That's how price action works, and that's how it can be used as a tool. So next video, we'll be talking about market structure and scale, and we're gonna talk about what causes price to change modes. Because today we looked about the different modes that exist, but we still don't know why price changed modes, where it did, and where it happened, and all that such. So we'll get into that later on, and again, taking it step by step. Hopefully you guys learning something or catching on to something. And if you're not, or something's confusing, feel free to drop a comment, send me a message. Again, I'll do my best to help you out. And until then, see you next time. Wish you all happy studying and the best of luck. Talk soon.